Welcome to the show. How are we all doing?
Doing well, thank you.
Great. Thanks for having me.
Great to be here.
Nice. And before we jump into today's episode, this Thursday, we're continuing our quest to find the smartest person in crypto. We whittled it down to 4 final contestants who will be duking it out for a Trivia Palooza packed with surprises, challenges, and of course, plenty of chances to win big. For more information, please check out the bracket. I should have the direct link to it, but it's not on hand. It's somewhere on .co. I'll tweet about it. But yeah, be on look at that. Should be awesome. But without further ado, let's get on to today's episode about oracles, real world assets, and DeFi. For crypto and DeFi professionals looking to contribute to a team committed to innovation in digital assets, Fidelity Investments is now hiring. Why Fidelity? For starters, they've been exploring Bitcoin and blockchain since 2014. They were the first traditional asset manager to launch a native crypto business and amongst the first to launch a Bitcoin exchange-traded product. Innovation is in their DNA. Fidelity invests in their talent by supporting and developing associates through continued education opportunities, casual crypto-focused discussion groups, and on-the-job experience working with new technologies. If you want to work on cutting-edge products and explore the new frontier of DeFi and blockchain, Fidelity is for you. Fidelity's products continue to improve and evolve, staying ahead of this rapidly changing digital asset landscape. Explore Fidelity Crypto Careers today. Go to crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. It's a new chapter for crypto and digital assets. Institutions are flooding in, regulators are defining clear pathways, and capital is moving at warp speed. Are you ready to level up? Campus is the digital gold standard in crypto education presented by LMAX Digital. Master the skills you need to thrive in this new crypto era. Head to theblock.co/campus to get started. That being said, Mike, we had a really interesting just back and forth before we went on live about RWAs, Pyth, and oracles. I'm kind of curious, how did Pyth land at the center of such a hot narrative?
Yeah, I mean, in some ways, we were like 4 years too early, and been waiting around for this for a long time. Like the core hypothesis that Pyth was created to solve is that people are going to want the price of equities and other real world assets on chain, and the current ecosystem doesn't allow, or the current supply chain doesn't allow you to easily buy data from, say, the NASDAQ or the New York Stock Exchange and be able to use that for any sort of smart contracts anywhere in DeFi. So that's what we solved. So we solved like the distribution, which is like the classic Oracle problem. Like how can you attest to something, cryptographically prove that that information is correct so people can use it in smart contracts, scale it, etc. But we also solved the data problem. So we've created this Pyth data source, and we did that by, instead of going and getting data directly from NASDAQ or NYSE, we get it from a lot of trading firms and other smaller exchanges. So there's like about 120 of these institutions, Jump, Jane Street, Susquehanna, all those big trading firms. They've got lots of data. They've never sold it before. They contribute to the Pyth network. And it allows us to create this data source that's novel. And we've been kind of twiddling our thumbs, waiting for people to use these equity data that we've had on there for a long time, because we wanted to be able to provide the price of, Tesla or Google without having to go to them and provide it on chain. Now, no one has used a equity feed. Very few people have used equity feeds in the first couple of years, just because of the regulatory landscape in the US was so hostile and uncertain. But this year, everything has changed. And so it's great. We feel finally vindicated. It's taken us a little bit longer than I would have liked to have gotten to this point. And we're starting to see all kinds of usage. And it's, falling into the wheelhouse that we designed this for. And it's very exciting. Like, it's exciting to see both what we had planned, which was like, there's going to be things like perps. And so like Trade XYZ on HIP3, which we work closely with. There's going to be also stuff we hadn't planned for. And so some of the stuff we were talking about before the show started was the way that like Backed or Ondo or Superstate have created these on-chain tokenized equities, and they're now trading on their own. So we've seen the evolution of it. The volumes are actually improving on some of these real world assets. I think we're set up to have a much bigger explosion of this happen in 2026. And so I think, we're very closely watching an environment where the market structure is changing before our eyes. Like overnight equities was a thing already, like a year or two ago. Now with on-chain, as well as what's going on off-chain. Off-chain is mostly done on Blue Ocean. It's something that we kind of work exclusively with from a data perspective. We're starting to see, the markets are really now stitched together. So it's cool. It's been a fun year. Been a breakout for real world assets, what's possible. But I think it's just starting to scratch the surface.
Okay, by the way, when Pyth started, it was initially sort of very like Solana focused, or sort of emerged, I think, mostly within the Solana ecosystem. Would you say these days it's sort of ubiquitous across sort of all chains, like it's gone beyond that, or is that still the case?
Yeah, it's certainly gone beyond that. So the quick chronology is the play on, of course, Chronicle there, is we launched in 2021 on Solana mainnet, and then we were basically only supplying data, verified data to apps on Solana. And when we wanted to go cross chain, we ended up about a year later, we ended up facing two problems. First one was we were already about 75% of the block space, and it was becoming expensive. Like when we first launched in September 21, block space was super cheap. But by a year later, it was already expensive because of the NFT excitement on Solana at the time. The other thing was reliability. Solana used to have those outages, doesn't anymore. So we ended up spinning out, creating our own version, called it PythNet, and only Pyth is on there. And we've continuously optimizing that. But we plugged it into Wormhole, and that's been our bridging partner ever since. And so we started growing chains, and we're at now, I think, 120. If anyone can name 120, good luck. But like it's, all the different layer ones, layer twos, and now we're very, very cross chain. We're still very active on Solana. I think we're still the dominant oracle on Solana by most metrics. But we also are a dominant oracle on many other blockchains like the Suis and Aptoses, and a bunch of the layer twos as well. So we're certainly cross chain. We're even doing further optimization. So like the newest version, PythNet v2, doesn't rely on the same Solana architecture. Is actually something that's been built custom for us to be much faster than the block times on Solana. So yeah, we've had a long storied history on Solana. Now we're much more cross chain, and trying to go beyond even blockchains. We now started servicing via our data arm on Pyth Pro, selling data to centralized applications, trading firms, other like institutions that need high quality data, and they don't want to buy it from NASDAQ or NYSE. They can buy ours.
Yeah. And how does it work in terms of like competition between Oracle networks? Like, would you say, like, what metric do you most compare yourself with? Because obviously, oracles aren't as simple as like TVL or something. So yeah, I was curious, and like, do you think, like, what percentage of Pyth is to, the size of Chainlink, or is it bigger than Chainlink? Like, how do you sort of measure that?
Yeah, there's a couple of heuristics that people use to measure oracles, and the two biggest are total value traded and the total value secured. We count ourselves to be the largest on the total value traded. We've got, I think, about 65 or 70% of the perps on any chain use Pyth as their oracle. And so when something's trading at that price, or using the price to underline the collateral or the funding, it's a big contingent of the risk parameters of the DEX. And so that's where we like to puff our chests out and say that we're the largest. Total value secured, Chainlink is the largest. I think mostly due in part to the strong relationship they have with Aave. Chronicle is obviously large as well due to the relationship they have with Maker, Sky. And the reason why these are sort of the heuristics. Oh, sorry, and let me just finish off. The other thing is, numbers of chains and numbers of applications. So we've got about 700 applications that are integrated to Pyth. That's huge distribution. Chainlink has, I think, a little bit more than that. So I think we're second in terms of number of true applications, and the number of blockchains you're on. I think we're on the most number of blockchains right now. The reason why these heuristics are there is because the revenue has been something that is not that well understood within oracles, and mostly because we're in the data business, And right now, crypto market data is a free product that's given away by exchanges in order to encourage people to come and set up a trading account. That is not the case when you look at like equities. Like if you go to equities and you want to buy data from, or you want to look at, real-time data, you can buy it as a retail person on TradingView. But if you wanted to get that as an institution, it is incredibly expensive. Like a Bloomberg alone costs, for one person, a Bloomberg alone costs about $30,000 before you're buying any premium data. All the data packages are like in the tens of thousands if you want to get real-time CME or ICE or NASDAQ. So that is a $50 billion a year business, selling like financial market data. In crypto, it's a $0 a year business, not zero, but close to it. So I think that this year has been really exciting because now the apps who are just like, the Oracle thing is just free. Like I don't I don't have to pay you guys anything. They can no longer do that because the data component is so expensive. So I think the paradigm has shifted dramatically for all of us in the Oracle space, where our end clients or our users who were just able to get something for free from everybody now have to deal with the realities of having to pay revenue to allocate revenue towards it. And so I think that over the coming years, we're going to start to have people figure out what the models are, be able to map and compare on a revenue basis. I think that it's good. Like that's a healthy stage of our cycle for us to be in. Given the fact that the narrative hype is kind of died out, at least for now, and people want to see like what are the real kind of revenues that you can use to back into valuations.
So it's interesting that, Mike, you ended with talking about what the future may look like. Niklas, I'm really curious because when we met, you have quite the background, especially within DeFi and crypto. So how did this like multi-chain future shape out? Was it as you anticipated early on? And how did you find yourself in Oracle's, I guess, moving from like your back end experience?
Well, I mean, so the way this all started, right, was there was a couple, early OG crypto people, right, who envisioned DeFi before DeFi existed, and they understood it to such a degree that they said, okay, what are going to be the primitives, right? What needs to be built? And at Maker, right, it was clear, okay, a stable coin, right? Every kind of crypto economy, decentralized financial system needs a stable coin. And then the next question was, what do we need to build a stable coin? Oh, well, we need to build all these other like secondary primitives. And so that's actually how I got started with oracles is we needed an oracle, but none existed, right? So it was like, Nick, go build us an oracle, right? And a week later, we had our first oracle prototype, right? So if you ask me, did I at the time think that we would be, securing $15 billion, right, with our oracle? No, absolutely not. But life is funny like that. I mean, fast forwarding, right, a few years, right? I think, Mike, you kind of touched on this, right? That the Oracle business is changing dramatically with the introduction of tokenized assets, right? Yes, right. On the one side, okay, the data is more expensive, but I think more like the archetype of what an Oracle is changed in 2025. I think prior to 2025, if you asked anyone, what does an oracle do? And they would tell you, oh, it's that like fortune teller that just tells you the price of something, right? With the introduction of tokenized assets, in order to embed them into DeFi, DeFi protocols need all kinds of contextual metadata to effectively be able to handle and manage a tokenized asset. And so in that, oracles have really had to change in what they report beyond just pricing. And I think that's quite exciting and is going to break open kind of the data business like more freely. But in particular, I would say like the TLDR is Oracle stopped just being like this very like singular piece of infrastructure and can now just be described instead as the glue that combines on chain with off chain, right? There's no way around this, right? And that's I think very exciting. Like year in review, right? 2025, like what did we see, right? We saw first tokenized money market funds taking off, right? Being a combination, right, of low risk, highly liquid. Monetary policy rates were historically high, right? So very attractive products that ended up serving a catalyst. And although, right, monetary policy rates are dropping now, I think it's so important what money market funds were able to do, in that they were able to bootstrap how protocols structurally and operationally interact with a tokenized asset, right? And that's been huge. So now that this has kind of brought on the onslaught of a bunch of new products coming to market now. I think CLOs and private credit have kind of been the story of the latter half of this year. These products are being kind of released in anticipation of this rotation of money out of the tokenized money market funds as rates kind of drop, right, and into these kind of higher yielding, less liquid, more structured products. I think equities have started to take hold, like in the public narrative. I think from a size and volume and liquidity perspective, right, they're still in their infancy, right? This is something that hasn't really hit that flywheel effect yet, but definitely will hit its stride in 2026. But going forward, I really think it's the structured products, right? The private credit and the more generally, right, the CLOs that are really going to be taking the lion's share of like growth in the following year.
It seems like on the retail side of things, you're finding almost like or at least it's very reminiscent to me of like what a brokerage account would be. I think of Fidelity when I think of, okay, stocks and money market funds versus the actual crypto element. But how is that different than what you're seeing like in these institutional conversations? What are these asset allocators like? What kind of questions are they asking?
Well, I think the important distinction to make here is who is the customer, right? Who wants to own these tokenized assets on chain? And I think from what we've, I think there's this misconstrued narrative, right? That, oh, there's all these retail people on chain, right? Who want to buy, I don't know, a Tesla stock on chain. That's not really what the data shows, right? What the data shows is that you have DeFi protocols, right? Which at this point are no joke, right? They're in the scale of tens of billions, now almost hundreds of billions, knock, knock, coming soon. Right now, essentially acting like funds themselves, right? Almost like fund to funds, right? Where they're able to allocate in size into these types of products, right? And so you see the DeFi protocols like Sky and Aave and Spark and Morpho kind of doing this. Morpho is a little bit different, more on that later, right? And you see the kind of treasuries, right? So the treasuries of L1s and L2s, right? Trying to kind of diversify to non-crypto correlated sources, right? So the market for those types of fund products is going to be very different from who is going to be buying these tokenized equities.
So it's interesting, but then I guess what would bring retail back into crypto, it seems like, or at least based on what I took from what you were saying, is though the narrative consistently is that retail is buying and using these products, it in fact is more so at the protocol level. So then how do these protocols actually in the end attract users and grow over time?
Well, I think it's just a different growth strategy, right? You can either be B2B or B2C, and at the moment, the scalar multiple is coming from B2B, right? Retail is a little bit muted at the moment. If there's a big influx of retail, right, that inequality could change, right? And all of a sudden, the B2C strategy might be more effective. But at the moment, right, if you look at the growth of the past year, right, if you look at the money market products like BIDL, USTB, JTRSY, if you look at the CLO products like the Janus Henderson JAAA CLO, if you look at some of these BNY CLOs, the Galaxy CLOs, right, these are all being invested into by DeFi protocols, right, and by treasuries, right. This is not retail adoption, but that's okay, right. It's almost like a water kind of filling a glass, right. It just takes the shape of the glass, right. And this is just the bootstrapping mechanism for these products at the moment.
Understood.
I would agree with that. I would just say that I think there are other areas where the retail is starting to get involved in the equities, and we're starting to see offerings that cover it. So, like we talked about, Trade XYZ, built on HIP-3. They've had a couple of days over $1 billion in volume. BitMEX is launching one. I think part of the big expectation is that when Coinbase has whatever their big date is, it's going to include tokenized equities, or at least equities listed on perps. So I think we're coming at it from both angles. And, historically, the reason why, in addition to the regulatory risks, the reason why people didn't care about equities on chain is because you're on chain because you're taking a bet on like NASDAQ 2.0. And so like you have this crazy high risk tolerance, and like betting on NVIDIA 5 years ago just didn't have the Sharpe ratio or the volatility that you were hoping for. This year has changed all that as well, where equities have done really, tech equities have done really well, and much better than I think most of the crypto beta. We've kind of round tripped it on Bitcoin, and if you're in alts, then you're probably down in the year. So now a lot of people who have exposure maybe want to have a rotation into equities. The other element of this, though, that I think is that long-term trend is I think there's still a big accessibility problem around the world where it's not super efficient to be able to buy equities in various parts of the world. Forget about the capital control places where it's like really difficult. It's just like there's not great options if you're in a bunch of places where you're going through these kind of bucket shop brokers, or you're trying to go through your broker, and like you have to pay these huge fees to get access to like the US capital markets. Like exporting the US capital markets to other parts of the world and to smaller investors is a good deal. Like it's a good business. And I think that crypto rails is like a great way to do that.
So then, Mike, I'm kind of curious, how do you think about these like corporate, like stable chains, and how they're going to interact with consumers versus institutions going forward?
Unclear. I don't really have a really prophetic view on how and if they're going to be very successful. I think that having chains that are specialists in something makes a whole lot of sense to me. Could be that it's like, stable coins are on, like all the stable coins, in volume and fees, like, it's been on Tether, has been on Tron for a long time. Like it works, right? Like, and so if you can find a niche within a particular chain, like Hyperliquid, on Hypercore has been, the trading chain. So if you can find a niche and you can find a reason for people to, want to use the blockchain, I think it makes sense. You have to be really careful to not like, get into that internet debate that happened at like the dawn of the internet, where all the intranet stuff died and people are like, oh, we're gonna have all these private internets. Like it feels a little bit like that. I don't think it is. I think that like the people that are behind these chains are smart enough and strong enough to be able to make them better. Like Robinhood having their own L2, for them to be able to compete with, Base or Hyperliquid makes a whole lot of sense to me. There's going to be people around the world that would rather have that as a clearing experience or from a UX experience. Or if liquidity even migrates there, at least now they're exposed to it. So yeah, I don't know. I don't have a really strong take. I think it's probably too early to tell with a lot of these corporate chains.
Niklas, anything you want to add there?
I think there's especially if you look at crypto Twitter, right? There's a sense of, I think, fear of a lot of these corporate chains, right? Oh, they have this existing big distribution and they're just gonna apply that, to their chain, and they'll just default be one of the biggest chains. I think that notion is a little bit misguided. I think just the fact that a lot of these institutions who are traditional payment processors like Stripe are releasing stablecoin payment rails, I think if anything is a good sign. It's showing that they feel their existing business is being threatened by the lower cost and utility that stablecoins provide, right? And so they are having to adapt, right? This is not opportunistic. They're being forced to do this. So I don't really see it necessarily as a threat. I just see it as stable coins are going to become like the default way to do payments, right? And everyone is scrambling to try to create the best product for those stable coins to move around. But in the end, this is all going to become commoditized, right? Like the cost of transferring money, even FX to a degree, right, is just going to come down massively compared to the traditional rails that you're seeing today.
I do think it's interesting that the product sort of business layer is different. So like, for instance, Tether is, sort of a stablecoin business that's built on top of Ethereum where, they monetize through the underlying assets. You could have similar payment platforms where the fees charged at the user interface level. But then you're also seeing these businesses that want to productize the underlying protocol. So for instance, Coinbase makes a lot of money from fees on Base. They've created a network where they actually make money purely just on the network activity, let alone sort of products they build on top of that. So I wonder at what point we'll find out which is the sort of product layer in crypto. And I do think it's related to stablecoins, because right now with stablecoins you can monetize the underlying assets, but if treasury bill yields drop, you lose a lot of the money you're creating. So there does seem to be a trend that they want to ultimately tax transactions, because then you make money from the order flow, not just from the underlying assets, which I think is why we're seeing a lot more stablecoin chains, payment focused chains, because I think people realize if they can charge a little bit money every time someone moves money between their wallets, in aggregate they can make a lot of money there.
Well, it's just like in Web 2, right? Like distribution's king. So if you own distribution, then you're going to verticalize as much as you possibly can. And it's the whole reason why Facebook and Amazon spent billions of dollars with these useless handsets, because had they gotten it, it would have been worth it. Like phone handsets years ago. So I think that if you've got the ability to move an audience because you've got a brand, you've got a niche, you got a moat, even if it's fleeting, then you can open it up as you described, like Base is, more or less a marketplace, right? Like, so if you can monetize a marketplace from your audience, leave them paying some tax to you, it's a great trade. So I think that we're just seeing this be attempted by everyone with as large of a distribution as possible. And we'll see what the verdict is.
I feel like it changes things a little bit, because I think the core idea of, say, like a chain like Ethereum is the idea that all of these payment networks would build their products on top of Ethereum, and then you'd get like the network flow towards ETH. But instead, you've got businesses saying, well, we're each going to build our own chain for our own business because we can capture like 100% of the value ourselves. You end up wondering if that takes off, then public networks could really lose out in that regard.
Yeah, Yeah, I think that that's been like the monolithic debate that's been going on for a while. Like Solana tries to really capture it, whereas Ethereum, let people do this. There's a very good argument for either. But despite all this in the layer twos, like Ethereum has retained, because of its brand value as well, has retained a significant premium. So if these, I don't know how it breaks down from a pure cost or revenue perspective. Like if everything had to start trading on the revenue multiples today, I think Ethereum wouldn't do nearly as well. But that's not necessarily going to be the case for a little while, where everything gets collapsed down to like the discounted cash flow analysis. I think that some new stuff will, and stuff with high revenue certainly will. But the brand of being Ethereum has benefited from everyone using EVM to go and create their own chain. Now, the two things that are competing each other that aren't either Ethereum, like it's going to be zero sum between those two.
So sorry, because I feel like we could talk about this topic all day. Like, is the L1? I think it's almost evolving into, is the L1 trade still extremely profitable? In that, it seems like from last cycle, Solana, Luna, Avalanche all benefit from being super vertically integrated. But going forward, part of that was because, or at least in Ethereum's sense, they achieved moneyness in a unit of account during the ICO boom and bust, then evolved into like this the Lego money DeFi summer, and NFTs, it seemed like, was an unrelated phenomenon in my opinion, even though there were some cool cross-breeded projects. But with stablecoins, you have that moneyness, but then it becomes distribution, especially in the third world where people don't have access to stable currency denominated just like accounts and whatnot. But with that, it seems like these companies are moving into this vertical because they're scared of their existing business getting commoditized, if you will. But with that, you're paying on distribution and network effects. How do you kind of achieve that? Typically in crypto in the past, it was, well, we're just going to make users of our chain wealthy, and then from there you'll have these downstream effects. But you can't do that with stablecoins. Kind of already done, unless you're betting on U.S. equities. That may change the conversation, but these aren't outlandish volatile returns that you typically see in crypto. So sorry, bit of a tangent. I don't know.
Sure. Look, I think what's kind of being missed here is, for years we tried to onboard, retail everyday people into a chain ecosystem. Okay, here's a wallet. Here is, Phantom or MetaMask. Okay, here is a block explorer, right? And we're trying to like onboard them into this like cryptic, no pun intended, type of world. And that's not where scale is going to come from. Scale is going to come from this infrastructure enabling new novel products, and then crypto just being used as the rails in the back end, right? So people will be able to benefit from new products and services, right, that are going to be extremely cheap, based off the fact that they're using stablecoin rails under the hood. But they may not even realize, right, that they're using stablecoins themselves. So I think it's less of a marketing thing, right? I think crypto often gets criticized for doing a little too much marketing and not enough actual product. And similarly, right, when you don't see like retail users on chain starting to go up, right, saying, okay, that was a failure. I don't think so. I think it just needs to become much more business to consumer, product facing, that isn't trying to onboard you into crypto. They're just trying to sell you a service that you might actually care about. So I
Understood.
do
And you
think
said
to an extent people have built up a little bit of an immune response, right, to, oh, that crypto thing, that's like those meme coins and scams and stuff, right? Like there's a little bit of a hesitancy there. But they'll use products at scale that use crypto in the back end, and they won't even know, right? That's how we're going to get the next 10 to 100x multiple.
well said. On the topic of novelty, I kind of thought about almost like investing in research and development versus one of the hottest metas now, which is buybacks. And obviously, Mike, you guys just announced like this Pyth reserve. So I'm curious at Pyth, how do you think about balancing like reinvesting in innovation versus, I guess, yeah, just like supporting almost like the token element of the project itself?
Yeah. So what I was talking about before, I think, is been one of the areas that has plagued oracles for a little while, is that people don't know exactly how the economic chain works. Like we have got staking, and so sure, like that supply side looks a little bit like a proof of stake network. So in our case, it's like the data publishers they're the ones that also do the validation. They're the ones that are staking to the network, and they'll get slashed. And so okay, fine, people get that part of the economics. But you don't have the same transaction fees. We've got some transaction fees, but they're relatively small, that are like being burned or sent out to these publishers. This all sort of changed now, and it changed now more materially due to this launch of Pyth Pro. So Pyth Pro is a traditional subscription-based data business. We sell data to both blockchain applications as well as non-blockchain applications. It's much faster than what we've been doing for the last few years. It's on this new architecture called PythNet v2. So we were updating at around 400 milliseconds. This now allows us to update at 1 millisecond. We are now pricing a whole lot more like accurately. We're benchmarking ourselves to things like the national best bid, best offer, and performing really well. Finding all kinds of new avenues for distribution and usage. And as a result, we started selling subscriptions to it. And the subscriptions range from free still for somebody who's building a small crypto app their first time. There's obviously not as performant of a feed for them. $5K a month for like the super fast crypto feed, and then 10K a month for enterprises for everything else. And our vision is to be the Spotify of market data. We keep adding more symbols into the feed every month. It just gets larger. You still pay the same thing, and then you can do more things with it. We think that's been missing from the financial markets for a really long time. This $50 billion a year business is just super complicated to be able to even buy the data. If you wanted to be able to access, a swath of different asset classes around the world, like going and getting Korea equities, it's not easy to get that data. If you want it to be low latency as well, it's even harder. So we want to be able to solve that in addition to somebody who wants, like, say, US futures data or US equities and so on. And so we started selling this, and it was immediately a hit. We passed $1 million in ARR within the first few weeks. We've been getting about 10 or so institutional inbounds every week. We've got over 80 APIs that are currently generated today. And it's just really growing. So that's where we thought that, okay, this makes a lot of sense. Like, we found product market fit here. We know exactly how to scale this. It looks like a SaaS business. We've got a distribution entity that is able to kind of paper this to real world people. That's Duro Labs is facilitating, and we have the DAO. And so the revenues that go back to the DAO, well, now you can use those to buy and accumulate the Pyth token. And it's a very easy to map model for people. It's like, more data gets sold, then there will be less Pyth tokens on the market. And I think that's a big milestone for certainly us, because we didn't have a very easy to explain flywheel in the past. And all the other things that we do where they generate revenue, either the cross-chain transaction fees. So we send data to these 100 or so different blockchains, about 4.5 million updates every day. Each one of those pays a small fee. We can accumulate those, and where we do accumulate those, and we send them to the DAO. That goes into this program. Any other products we have like a random number generator called Entropy. There's a few other things that we also have. There's some listing fees as well that people will pay to get a symbol listed. That all goes to the DAO. And then every month, the DAO will take a third of the budget that it has and go out and buy a Pyth token. So it leaves it enough wiggle room for it to be able to do other things. But this is a well-worn path with regards to selling data. It's very sticky with a business, and able to kind of create this flywheel.
Cool. I was just curious. Obviously, sort of Pyth and Fogo are quite closely connected. What did you think it was the right move for Fogo to cancel the pre-sale?
Yeah, I think so. I think that was the right move. I think that the market appetite for ICOs over the last couple months, post Monad, and to some extent post Mega ETH, has probably changed quite a bit. And if you have the flexibility to be able to not do it, I think then that's a very strong move. I think the intentions for why it was going to happen, Rob Sagerton, who's the founder of the chain, he talked about, like, this was a distribution event to try and bring people into the ecosystem. And there are other ways to achieve the same end result. So, by incentivizing people via an airdrop, there's a huge amount of marketing that earned media that I think went into the interaction that Rob and some of the team had with people on it. I think that there's, at least my perception of it, is that there's a whole lot of goodwill as a result of foregoing that, because people were skeptical that it was some sort of cash grab. And so if you cancel it, then you say, okay, fine. You know what? This is very clearly the means was to be able to engender a community to go and try the chain. It's live today. Use it. Go and do this airdrop or this pre-sale on the chain itself. So all those things were important, but not necessarily worth alienating a group of people that are now finding out about Fogo for the first time. So I think, from my perspective, it comes from a position of strength to be able to pull this off. And I think that people are excited about it.
I was actually curious, going back a bit to the actual business models behind the Oracle businesses you guys are both helping build. Niklas, when you don't have a token involved, how do you think about virtuous cycles and scaling the business that you guys do at Chronicle?
Well, I mean, just like any business that doesn't have a token, right? We earn revenue off of the services that we offer, right? So we have our kind of core DeFi Oracle product, right, which has been on the market for going on 9 years now, right? It's like the longest. It was the first Oracle and longest running Oracle now. So that product's been generating revenue, right, across I think 20 plus chains at this point. And then earlier this year, right, we launched a new product specifically catered towards tokenized assets, right? So essentially the key unlock here, right, was a purpose-built Oracle for tokenized funds and private credit, where kind of transparency, automation, and data integrity kind of dictate how institutions can scale these types of products. So we kind of pioneered this originally through our kind of partnership with MakerDAO, who we've worked very close with for many years. I was actually a founding member of MakerDAO back in 2016. But there in Maker's like early forays, right, we got a taste of when we did a pilot with Société Générale, and right, one of the largest French banks, and what they wanted to do was tokenize a French mortgage-backed bond, right, and then refinance it through Maker, right? And so that was like, I think 2018, 2019, and we just got this huge like insight into all of the problems, right, that DeFi was going to have trying to like onboard these non-crypto native assets, right? And so it was really over the years that we like built up that experience of like, okay, what is the problem set? How are oracles going to play a role in that, if any, right? And that kind of led us to launching that product earlier this year. It's been a hugely successful product. We've scaled it since January of this year to just under $6 billion in tokenized funds, and so that's easily going to like outscale our DeFi product, right, which I think stands at around 10 billion at this point in time, right? So 10 billion built up over the course of 9 years, right, versus half of that, right, in less than a year. I think it's also a sign of like where things are going. I think what people think of as DeFi right now, so like is just going to get eclipsed next year, like by multiples, like many multiples by these fund products coming on chain. I think institutions are not very dogmatic about a particular chain. Like they're not going to say, "Oh, we think Ethereum is better than Solana," or "Solana is better than Ethereum." They're just going to launch on all of them. So, from an infrastructure perspective, right? And I'm sure Mike, you're seeing this as well, right? You, as an infrastructure provider, right? You're quite agnostic when it comes to any of these chains. So that's been like a very good driver of revenue for us this year, right? And so like token or not, right? It's either equity becomes valuable or maybe one day a token becomes valuable, right? It's just business.
Understood. And there's some spicy takes you snuck in there towards the end of the monologue. We are running low on time as we're like 1 minute over the hour. But Mike, I want to give you a chance. Any bold predictions for 2026 before we wrap up?
Yeah, I think that like, big institutional adoption continues. So the things I was most proud of from this year was number one, working with the US government to get the GDP on chain. We've expanded to a bunch of other types of information. We're working with a bunch of other government agencies to do some really cool things. And with a bunch of other large institutions. So, that feels like it's one of those slow trains that is certainly moving, but with it moves a whole lot of weight. And then, continuing to see us break through into more and more off-chain markets as well on Pyth Pro, and then support a lot of the growth for real-world assets in DeFi. So scaling, growing, and helping push the boundaries on what's possible.
Oh, well said. Thank you. That being said, that's all the time we have for today. I want to thank Niklas and Mike for joining us this episode. As a reminder, our newsroom works tirelessly to get you informed, accurate crypto news. If you want to stay ahead, read the block. Thank you and see you next time.